Welcome back to the Multifamily Investing Podcast. This is Charles Dobbins, the founder of the Multifamily Investing Academy and the multifamilyattorney.com. And every week we delve into the good, the bad, the ugly, the comic, the heartbreaking stories of multifamily ownership. They will inspire you to do what you've always dreamt of doing. So sit back and enjoy the best training on multifamily investing on the internet today. Enjoy.
Yeah, that's a great question.
Yeah, that's a great question.
It's a great question.
Great question.
It's a good question.
This is a really good question right here.
It's a great question, by the way.
That's a great question.
That's a really good question.
Yeah, so that's a great question, Charlie.
Great question.
Yeah, that's a great question.
You know, that's a great question.
Good question.
Great question.
Great question.
Yeah, I get that a lot. Hello, everyone. This is Charles Dobbins, the multifamilyattorney.com and the founder of the Multifamily Investing Academy, also the new founder of the Multifamily War Room with my partner, Jillian Sidoti. And I'm here today on my podcast with John Azar. And John, I've never had to do this before, but I'm actually writing your name down right here. So that, because I think I'm going to screw up your name. I think I'm going to be calling you Tony the whole time. And so
That's all right. That's all right.
I don't want to do that to you, because for those of you that don't know, I've known Tony, John's brother, for years. And Tony and one of my dearest friends in this business, Bob Bryanton, are partners on a lot of deals together. And when I was down there visiting Bob, I've actually been to your office. I went and I met your.
Yeah.
Are they your nieces? It would be your nieces, right?
Yeah.
Five girls?
Yeah.
So
That's my niece.
let me tell you something, folks. This is the way that Tony has set up his business is really cool, because we talk about generational wealth. Not only is Tony building generational wealth, he's already got his generations working with him. He's got his daughters in there, helping out. And now, John, I don't think you were with him when I met him.
When did you meet him?
Oh, geez, I'm gonna say maybe 5 years ago.
It had to be more than that, because I've been down here for more than 5 years. I've been down. You must have met him maybe in 2014, because
That's probably that could have very well been. Yeah.
Yeah. Because I came here in late 2014 to help grow the business, and 2015, and been here since.
All right, this is so cool, because I really want to hear about Tony's business. I want to hear about you how you were brought in, what you're going to do, and also I'm going to really come at you and ask you some probing questions about your fund, because a lot of people really want to get it started. And I can tell you, folks, if you're looking for a place to put some money, if Tony's creating a fund like this, it's a definite good solution for you, because Tony runs his business beautifully. And, this is, it's one of those things where when I met Bob Bryanton, I knew he was going to be a success in this business on our first phone call. And Tony's background was he owned a software company, wasn't it? Or something to that effect.
Yeah.
So he ran a business. He knew what it was like to run a business. He knew how to cover payroll and what have you. So, he approached the multifamily business the same way, which is why he's done a fantastic job. So what's it like taking orders from your younger brother, John?
Older brother.
So where were you before?
I was in Boston for many years. Yeah.
Oh, where were you?
I was in Boston for forever. I mean, I was in Boston in all over the place. My family's in Lexington. My mom and my sisters live in Lexington,
okay,
Mass. And I lived there. I lived in Winchester. I lived in Somerville. I lived in
Winchester. Right after we had my daughter, we moved down to Winchester, and we eventually bought in Melrose, a couple towns over.
Yeah.
Yeah, and so I have a house down in Duxbury. That's where I raised all my kids, was down in Duxbury. And,
nice.
Yeah,
it's a beautiful area.
Oh yeah, I love it. It's gorgeous. But Winchester, gorgeous Winchester. I don't think you lived near where I lived, John, in Winchester. I lived on Swanton Street. You've been on Swanton Street if you've ever had to go to the dump, because I lived right next door to the dump when I lived in Swanton, when I lived in Winchester. So
I lived right next to where the country club golf.
Oh yeah. Oh
So-
yeah,
so
they got a great
right
country
there,
club.
right near that cute little farm that they have over there.
Yep,
It's,
very cool.
yeah.
Very cool. So
Yeah.
then you made the move down. You left Massachusetts, bravo, and you moved down there to North Carolina, or is
Yeah.
that where? Yeah.
Yeah,
Okay.
exactly. Yeah. I mean, I was involved with Tony before, but we didn't really decide to pull the trigger on MACC Venture Partners until about 2013, 2014, while I was still up in Boston. But obviously we couldn't make it work while I'm still up there. Co-running a business from 1,000 miles away is not something
Oh.
that is optimal, especially a business
Okay.
like multifamily. So it's not
Okay.
really something that, you know.
Okay. It's so, folks, I didn't prompt him. I didn't tell him to say this. This is just practical life experience talking that you can do it. You can run a multifamily business 1,000 miles away, but it's not an easy thing to do. I mean, it's just, especially if it's your first business. I mean, oh gosh. And these gurus out there teaching people like, oh, go, 1,000 miles away, go to the emerging markets. That's a tough solution. I mean, you need to do it right in your own backyard. And
Yeah.
how
Yeah,
did
for
Tony,
sure.
How did Tony end up down there? Like, how did he start?
Tony was always down there. So I mean, I don't know if I'm assuming you know that we're immigrant. We're Syrians. We came to the United States. Tony came first before the rest of the family, and he was always in North Carolina. He was always North Carolina based.
Really?
So the family immigrated to different places. North Carolina. My sister ended up in Boston and went to med school up there. And my mom and dad were in between two places, and then my mom moved up to Boston eventually and lived near my sisters, and my other sister moved up there too. So we've always kind of been a split family between different areas, as a lot of immigrant families are when they kind of move to a new country.
Yeah.
So
How old were you when you moved to the United States?
I was 16 when I moved to the United States. Yeah.
And let me ask you, did you speak English?
No, I didn't speak any English. I spoke Arabic and French when I moved to the United States.
Are you kidding?
Yeah.
Wow.
Yeah.
Wow. God, that's great.
Yeah.
You sound like a native. You really do. You really do. So
thanks. Yeah, it's having to not be alienated as a teenager and having to not be picked on is what instigated me losing any kind of accent and obviously perfecting the English language.
So you moved over here and obviously you started selling Oriental rugs, like because that's
exactly,
Yeah,
and then open a gas station after that too. So.
That was my next choice. That was my next choice. You beat me to it. That's so funny. Oh man! Now
and right next to the gas station, I opened a hotel. So
and you always had that going out of business sign on the rug store.
Yeah, the rug store was great. We had rugs at the gas station and at the hotel, and we had a rug store.
So. Exactly. I mean, how many more stereotypes can we go through right now? Oh man! So what you sound as though, I think you alluded to it earlier, that you were in like the finance side of it, or what were you?
Yeah, I was in investments. I've always been in investments, in the
Okay.
investment side of the business. I started out as on the equity desk at Morgan Stanley back in the late 90s, early 2000s, and then moved around in institutional investment world for a long time. I was, like I said, I was with the Royal Bank of Canada Capital Markets Group. I was with John Hancock Institutional Markets Group, and then I opened my own company in 2004, essentially doing structured finance for large-scale mixed-use development, and that's when I got into real estate. So I got into real estate on a commercial real estate from an investment banking standpoint. Slightly before Tony was in multifamily, but he was doing real estate in a different way. At that time, he was doing single family sort of rehab and flips in North Carolina at the same time as I was going through opening my company, structured finance company in Boston. So, and my company was open from about 2004 to about 2008. I had a couple of partners and we had amazing projects going on all over the Eastern Seaboard. These are all great projects. We made a ton of money from 04 to 08. And then in 08,
Gone.
Something done.
Something happened. Oh, we're
Something
still
happened.
scratching our heads.
Something happened. I don't know what the hell happened in 2008. But
We had to wait for the movie The Big Short to come out to explain it to us what
yeah,
actually happened.
yeah, exactly. But we woke up and overnight our business dried, our clients went away, our investors went away, and we were in trouble. We were in trouble, and we had to. My partners had to. We all had to shift gears, and we all had to go back and get day jobs. My partners had to sell houses, cars. I mean, so we had to sort of start from scratch.
Yeah.
And that's what you do.
John, not so proud. Happened to me too. We all went through it, and we all survived.
Yeah.
So,
yeah. So around the same time, around that 2008 timeframe, when my company was tanking, Tony had started MACC Properties, which is the earlier version of MACC Venture Partners and Capstone Multifamily Group, and was just starting to get into multifamily and starting to buy multifamily between 2008 2009. So that was kind of the start. So he was getting his start while I was trying to find a day job and kind of licking my wounds.
Yeah.
And then a few years later, we got back together, and I moved from Boston to North Carolina and grew the company.
Okay, now let me ask you this, and I don't know if I'm going to ask this question the right way, but you have a lot of experience from the equity side, from the real Wall Street side of the business. How do you apply that to analyzing deals, raising money? I mean, is there some type of analysis that you do that is a little bit more advanced, or it's different than what we as multifamily investors are used to doing?
Yeah, I mean, look, all it did is just give me somewhat of a better understanding, a different critical way of looking at pro forma and P&Ls and numbers are numbers. But for the most part, Wall Street guys are not multifamily guys.
Yeah.
And, so they're just not. And I knew I had a lot of learning to do as well. So it's not just because you came from the finance world, and that's why that's the reason why I started a new company recently called Peak 15 Capital, which I'll talk about later. But there's definitely a disconnect usually between Wall Street parlance and multifamily commercial real estate parlance, and it gives you, obviously, understanding the investment world gives you a very good understanding of numbers and how to start building core relationships with institutional investors, which is why I came to join Tony, and so we can sort of retool our business, because we were at an inflection point where we needed to kind of retool and kind of grow the business in a different way. We were right around, right under 2,000 units when I joined the business, and we needed to go to the next iteration of our business. As of last year, we grew the business up to 6,000 units, but so we needed to, as in any company's evolution, you need to retool in different stages of your growth, and that's part of it. But really, all that being said, my Wall Street experience, or my investment experience, is paled in comparison to what I needed to learn in multifamily. And so my question got to where I wanted to go, which is just to see, was there a learning curve for you to make the shift from an equity desk to a raising funds for a multifamily deal?
Hi, this is Charles Dobbins, the founder of the Multifamily Investing Academy and the multifamilyattorney.com. And I want to invite you to check out the best coaching, consulting, mentoring program on the internet today, the MFIA Owner Forum. Now, if you're looking to jumpstart your multifamily business, this is the program for you, because it protects you every step of the way to make sure that you do these deals the right way. Believe me, I've done enough deals. I know how to do it the wrong way, and there's no need for you to duplicate my past efforts. So what the Owner Forum is a group of multifamily investors, all different levels. Some own 4,000 units, some haven't bought their first property. But we all come together to help each other get across that finish line. And within the Owner Forum, what we do is remove all of those roadblocks that every single multifamily transaction has. Check it out. Go on our webpage, click the link. Try it out, risk-free, money-back guarantee, and this is not one of those $30,000 or $40,000 or $50,000 coaching programs. Those are ripoffs. The Owner Forum is a program that you deal with every single month, and we help you every single month get to your goal of being a multifamily investor. So check it out right now, and I'll see you on the other side.
Oh, absolutely. Absolutely.
Okay.
There's definitely, I mean, there's a big learning curve. Absolutely. I mean, because again, you look at numbers, you're looking at numbers only, but numbers don't tell the stories. Walking through an apartment complex and looking under the hood and finding what kind of wiring and talking to the
you're
tenants.
killing me, man.
You know?
You're killing me. You're like, it's like you're one of my students. It's like you've listened to every one of my podcasts before. Because as I say, the numbers tell the narrative. The numbers tell the story. You can tell what's going on in a multifamily property just by looking at the numbers, if you know how to read those numbers. So that's so cool that you just said that.
Yeah.
But let me ask you this. Give me some examples, just if you can think off the top of your head, of things that you learned about the numbers, things that surprised you about multifamily numbers, things that said, oh man, I better not make that mistake again if I do this.
I've learned and still learn all the time. I mean, that's the beautiful part about this business is you learn every day. You learn something new all the time. And, you know, the numbers, you know, you learn one of the first things I started learning is your assumptions are just that. They're assumptions. They're not gospel. You know, they don't end up as gospel until you actually go and look under the hood and, you know, talk to the property managers, talk to outside people, go drive around the area, see what's going on. You know, see how many stops the cops are making, see how many, you know, how many check cashing places around, or Starbuckses or Whole Foods, or, you know, and you know, that's what tells the story. It's not just looking at the numbers.
And just let me give you a little tip. One of the best things to do is call the competitive properties in the area and speak to the property man or the woman or whoever that runs the property. They are the chattiest Cathys you could ever imagine. They tell you all the gossip of what's going on. You'll learn more about the property that you're thinking about buying than you'll ever want to know. And those are the best people to talk to.
Yeah, absolutely. Absolutely.
All right. So Tony's out there. He sells his software business. He goes and takes a couple of courses in multifamily, and he decides, this is what I want to do. This is how I want to grow my life and my family. So he goes out there and starts buying up multifamily properties. Do you remember how he got started? Like where, essentially, more importantly, like how he got the money? Because I want to take the rest of this discussion through the money side of it. So how did he get started?
Well, like any multifamily syndicator, when you first get started, and that's what I tell a lot of new aspiring guys. You know, I do a lot of coaching and mentoring as well. So, what I tell is just start small. I mean, you start. You know, you eat the whale one bite at a time. So, people have always probably sick of hearing me say that, but start with your local network. Start with your friends and family. Start with gathering money from people that love you and know you and trust you, and start as small as you want. I mean, our first deal ever was an 80 less than 100 unit 88 unit deal in Augusta, Georgia, and
I did my second deal was an 88 unit deal. So So that was our first deal ever, is in Augusta, Georgia. It's called the Fairway, and we still own it, actually. So Tony's sentimental about it. He doesn't want to let go of it until he has to. Big mistake. You got to break him of that. You can't get sentimental over
I know. But that's the only one he's sentimental about. I was able to not have him. He's not sentimental usually about any other property.
But that one he is.
That one we still have.
I just can't part with it. I just can't part with it. Come on, Tony. Let it go. It's already doubled in value. It's more than doubled in value, for crying out loud.
Oh yeah, no, absolutely. But
I
mean,
using that thing as an ATM.
That was a small.
Tony's probably using that property as an ATM machine right now. You know.
That property is definitely just a pure cash flow. So for sure.
Yep.
And so you start out with, I mean, that one was just friends, family rounds, local investors. I think I think your friend Bob Bryington was probably,
I think he was too. Yeah.
So,
he may have brought the deal to you guys, or there was a lot of that going on back then between the two.
Yeah. There was some back and forth about that. Yeah. So, but in any case, you utilize who you know, who you have. Don't go far. Tap into the local network.
let me just before we move forward, let me just say the whole thing about eating the whale one bite at a time. These people who say go big or go home. I'll tell you, John. There have been times I've liked the second option better than the first one. I'll just go home. My bed is nice and safe. I'll just walk away from it. There's, think about that other option. You got two options: go big or go home. Just go home.
Yeah.
But so he raised the money, friends and family, to get into his first deal. Now, he's up to how many units now? I read 2,000, but I think it's a lot more than that.
6,000.
6,000 is what? Yeah. Okay.
Yeah.
So
6,000.
Folks, listen, this guy started with an 88. He's got 6,000 units now. And one of the things that he did that I tout, see, Tony is doing it the way I did it. He owns his own property management company. He manages the properties himself. That's the way to do it. He's built up an amazing.
But we did
business.
that. But just to preface that, though, Charlie, we did that. That only came after we hit about 1,500 units.
1,500. Okay, so I did it after about 300, but 1,500. But the point, John, is at some point you just do that.
Yeah,
it's your business. That's what we do. Is we manage. Nobody loves our baby better than we do.
Yeah.
So now what you're looking. So up to this point, all of your deals. Now, obviously, you guys are now in the stratosphere. You guys are able to pull in cash from different places. But up to this point, all of your deals have been one-off deals where you get a deal under contract and then you raise the money for that one deal. You haven't run a fund yet, have you?
We have.
Okay.
A few years ago, we did some targeted asset funds that we raised specifically to acquire a portfolio of assets. And that fund closed and just having those assets. So a targeted asset fund essentially it's not a true fund in its format, but you raise money similar to how you raise in a fund, but the fund is targeting only specific amount of assets and it will close after it acquires those assets.
Oh,
so
that's really interesting.
Yeah. So we did that with a couple of different portfolios we acquired. We did that with a Nashville portfolio that we acquired. We did that with a Knoxville portfolio we acquired. So we've done that a couple of times.
Okay, so
it worked. It worked nice.
Okay, but the thing about that that I want to make sure everybody understands is it sounds as though when you guys were buying the targeted assets for that fund, that was all one transaction. It wasn't like you had 3 different properties with 3 different sellers. You had a portfolio. And so
that was
okay.
That's right. That was one transaction.
Gotcha.
Yeah, that was
gotcha.
one transaction.
Okay, so that's easier. But on the investor side, that's a pretty good way to do it, because if you can diversify your deals over time, over different properties, you're much better off.
Yeah.
But okay, so that is really, I mean, it's I want to say it's kind of like a hybrid between a one-off and a fund, but it really is still kind of a one-off deal. I mean, you guys are doing the whole thing. Yeah. So now you guys are at the point you're ready to do a fund. Okay, why? Why now? Why is doing a fund better or the next move for you in this process?
Just to preface this, the fund we have structured it. We have putting the chassis in place. We've put in the infrastructure in place, but we decided to put it on hold until after we get past this year at least, and kind of reassess
COVID year.
Yeah. So the fund is just so everybody knows, the fund is on ice for now until we sort of get past this year. We decided to kind of put the brakes on it just because we just don't. It's been very, very challenging in the past few months, as anybody would know, in this environment. But having the idea of having a fund in general, which is essentially an aggregated pool of assets or pool of capital, is so that you can have capital ready to deploy on demand without having to go to market, syndicate each deal at a time, go out to your different investors, do the whole vetting. It makes you, three main reasons why a fund would make sense if you are in a position to do a fund is you're able to pull the trigger a lot quicker without having to rely on going out there and raising capital. So that puts you in a better competitive situation as far as closing timeline, as far as due diligence timelines, the whole 9 yards. You're not scrambling last minute to do that.
You can write
You know?
your offer in such a way that you're more attractive to the seller.
Exactly. Absolutely. And B, you can diversify a little bit more because you can make your funds not only buying assets for your own portfolio, but you can also invest in other portfolios as well, or other people as well. So if you
Oh,
and that's the
cool.
way we wrote our funds, is not only can we buy assets for our own portfolio as a co-GP, or but we can also invest in other people's portfolio as a co-GP or a JV. So we can maybe find a deal that's in, I don't know, like Denver, Colorado, that might make sense to us and might be really great. We have the ability through a fund to invest in that deal and essentially become a co-GP in that deal.
Very interesting.
So that's another reason. And the third reason is just again to give you a lot more sort of flexibility and peace of mind, and about having your own pool of funds that are ready to go. You're not necessarily taking all the money up front and holding it. So the way that you raise money for a lot of commercial real estate funds is it's all based on capital calls. So you're not telling your investors, I'm going to hold your $500,000 until I find a deal 6 months from now, and I'm going to sit on your $500,000 for the next 6 months.
Okay, so let me ask you this: if I put $100,000 in your fund, essentially what you want from me is a commitment for $100,000.
Correct. It's called a commitment letter, actually. Yeah,
exactly.
It's an actual legal document. So.
Out of that $100,000, how much are you going to need from me on day one? What percentage?
You just put it's almost like putting down. It's almost like a layaway. You put down a down payment.
Yeah.
Like, it's 10% down out of the 100,000. So you put $10,000 down just so you can have your commitment locked in.
Yeah.
And then the rest of it is on call. Is based on capital calls.
Okay, I want everybody to understand this because this is really crucial. Like, how big is your fund going to be when you close it? What's the number?
The number that we were shooting for is anywhere between 75 million to 100 million.
100 million. Let's say 100 million. So, folks, when John's talking about $100 million fund, he doesn't collect all the money and it sits in his bank account while he's out there looking for property. It has to do with the acceleration of the velocity of money. I mean, if he takes that 100, it sits in a bank account at 1% or even less. He's hurting his returns for his fund. So he doesn't take the full 100,000 at once, but he's got commitments of that 100,000. Now, here's the thing, and John, you know how it works, on the equity desk and what have you. You better find a home for that 100 million, because if I tell you I'm giving you 100 and I'm committed to it, I got to put that money to work, or I got to find another home for it. So you have to get to work.
Oh, absolutely. I mean, the other side of getting the money is actually placing the money. That's the 50% of the equation. It's not just raising the money. And that's the other reason we put the fund on ice for now, is because in this environment, as frothy as everything is, we didn't feel like there's enough in there that would make the numbers work for us. I mean, obviously you don't want to be frivolous with your fund's money. You don't want to be frivolous with anybody's money at all, to safeguard everybody's money. And if we want to perform our due diligence in our numbers the same way as we have throughout our portfolio, and get the investors a return that they're used to getting with us, which by the way, they have been spoiled in the returns they've been getting with us.
Yeah.
We spoiled our investors with getting some amazing returns in the past 10, 12 years.
And let me tell you something. Let me just hold it there, because I know Bob is involved with a lot of your deals too, and what have you. And I hear the spoiled stories from him too, which is a phenomenal way to run your business. So
Yeah. So you got to be diligent, and so $100 million you raise levered, that's buying $400 million worth of assets. So you better be ready to pull the trigger on $400 million worth of assets.
That's a lot of sleepless nights. Yeah.
That's a lot of work. And it usually comes with a timeline. So when you raise a fund, you don't have unlimited amount of time to place the money. You have usually a very short amount of time. It's usually between 1 to 2 years to place the assets.
Yeah.
So you can't just willy-nilly say, well, I'll take the next 5 years to place the money. You can't do that. You have to place it within a certain amount of time.
Which is why having that ability to invest in other people's deals is going to help you. Because if I come to you with a beautiful 300 unit property, I said, hey guys, it's right in your backyard, it meets all your criteria, I get it on the contract, I'm going to go out and try to raise the funds, or I can work with you. You'll say, hey, come on board. You know,
That's right. That's right. Yeah.
That's
That's
very,
why a sponsor fund is really, we're calling it internally a sponsor fund because
Yeah.
it's really a fund created to
sponsor
not
other
only work for us, but also invest in other sponsors.
Excellent. Awesome. That is so cool. Now, let me ask you this, because I've often wondered like what your mindset would be on this idea. One of the things about having a fund and having ready capital to move, and as I mentioned before, allows you to draft an offer that it's very attractive to the seller. One of the things I always thought about doing is if you had that fund, you write the offer such that the earnest money is hard on day one. If you accept our offer, you got $100,000, and you guys can afford to lose $100,000 because you'll just make it up on the next one. $100,000 or $200,000 is pocket change to $100 million fund, but it gets you that deal. It makes you stand out among all the other offers. I mean, is that something you've thought about doing, or would you do?
Yeah. I mean, look, man, Charlie, you got to do that these days, regardless whether you have a fund or not. I mean, it's unfortunate. It's the unfortunate reality of competing in competing for business these days.
Yep.
I mean, it's you're competing against people that are. It's just crazy offers out there, and that's why it's an environment that we decided to pull out of. These, starting last year, we decided to kind of take a step back from acquisitions, and this year we took a huge step back in acquisitions. I mean, we are pretty much taking we're taking actually chips off the table this year as opposed to pursuing new acquisitions. We are selling some assets. We're down a few hundred assets from what I told you our count is concerned, and we are going to be down a few more hundred assets just because we're selling off and we're taking chips off the table. And we want to be ready with some liquidity next year. We want to retool. We want to look at the fund again and see if when would be a good time to kind of pursue that again. But it's been a very, very challenging environment this year.
Yeah,
for numbers.
I think you're doing it absolutely the right way. Absolutely the right way. One final question before we wrap it up here, and I just want to pat myself on the back, John. I'm not going to need this note anymore. I never once got your name wrong the whole entire time. How's that? Huh?
You're doing good. You're doing good.
I did.
You're doing good.
I did.
Absolutely.
So I had a guy on my podcast last week, and he's doing a great kick-ass job out in LA for 5 to 15 unit properties. Now, and these are Class A locations, C-class property and Class A locations in LA, 5 to 15 units. You and I think, oh, that's tiny. It's a big number, like $400,000 a unit. So he started off with 2 funds, and the 2 funds were $15 million funds.
Okay.
And then he was just rolling out his 3rd fund of $100 million fund. And I said, how did you make that leap? He said, I had to, from a business perspective. He says, I had the right business model for family offices. They loved what I was doing, but they couldn't put their money in my fund because they had too much money and I didn't have a fund big enough. So the only way I was able to attract those family office funds was to have $100 million fund. I mean, what's your thought process on that? What do you think about that?
Yeah, absolutely. You gotta, I advise people all the time. Again, I advise people now on capital a lot more through my other company. Again, I think I mentioned it, called Peak 15 Capital. I launched that last year in working on that a lot this year. It's just in case
it doesn't work out with Tony.
We're actually really it's what it is capitalizing on our expertise in both multifamily as a sponsor and capitalizing on the expertise of our institutional relationships and private equity relationships with companies. So we're, Peak 15 is just offering an advisory platform for sponsors mostly to bring them money and help them structure their deals. So that's really what it is. But to answer your questions, sometimes the challenge with raising a fund is that when you go to institutional investors or endowments or foundations or large family offices, they have a minimum check size that they can write for you. So, and if you have a too small of a fund, they don't want to write you a big check size. They don't want to write you a check at all because their minimum check size may be $15-20 million. And if your fund is 50 million or 40 million, they don't want to take 50% of your fund. They don't want to be that, they want to be 10% of your fund or 5% of your fund. They don't want to be more than that. So, in order for you to get that, those big money to big family offices, you got to go bigger. It's not one of those go big or go home kind of thing, but you got to go bigger because you want to attract some of those bigger checks. to survive.
Exactly.
Exactly.
Very cool. Awesome.
Yeah.
John, how do we get a hold of you? Especially, how do we keep our eye on this fund? How can we, because if somebody wants to sign up to get more information on it, because I like it, I love the idea, and we're always looking for deals, and we should, obviously, I know how you guys work, and I like your business, and
yeah, just keep track of our website, macvp.com, maccvp.com.
Okay, it was MACC, right?
MACC, yeah,
Two
correct.
C's, everybody.
Two C's.
MACC.
MACC VP is in venturepartners.com.
Got it.
So maccvp.com. You can reach me at a couple of different emails. You can reach me at john at macvp.com, or you can reach me at Azar at peak15cap.com. So AZAR at peak15cap.com.
He's John Azar. He's the good-looking younger brother of Tony Azar, and he'll use that title for the rest of his life.
Edit that one out. I don't want him to get pissed off at me. Edit that one out.
Nothing gets edited in this podcast here, John. John, it was so good talking with you. Thanks for being on the show.
Thanks so much, John. Appreciate
Awesome,
it.
man. I'll talk to you soon. Well, next time I'm down in Nashville, I'll come looking for you.
Yeah, man. Next time you're in Charlotte, Asheville, in North Carolina, come find me.
I will. See you, buddy.
All right, buddy.
You've reached the end of another episode of the best multifamily investing podcast ever. For free resources and materials, head on over to www.multifamilyinvestingacademy.com. And if you love the Multifamily Investing Academy podcast, I'd love for you to subscribe, rate us, and give us a review on iTunes. And until next time, this is Charles Dobbins, the multifamily attorney, signing off.